The evolutions and the trends of the fraud incidents in the private and the public sector banks in India were analyzed and revealed that the public sector banks suffered heavy losses due to fraudulent activities, and it is a major setback for the entire economy. The country's financial industry has been stunned by the number of high profile banking frauds that have happened in India in the recent years. These frauds raised a concern about the integrity of the financial systems and they demonstrated the urgent need for the stricter regulatory measures and increasing the surveillance. In this article, we examine the top 10 banking scams that have irreparably changed India's economic landscape. The first scam is Nirav Modi and the PNB scam, Punjab National Bank scam. The Nirav Modi and the Punjab National Bank scam, which unfolded in the early 2018, was a massive fraud that shook the Indian banking sector. Nirav Modi, a well-known jeweler, and his associates had managed to defraud Punjab National Bank of staggering rupees 11,400 crore. So here's how they did it. So Nirav Modi and his associates colluded with the certain PNB officials to obtain the fraudulent letters of undertaking, that is called LOUs. These LOUs were used to secure the loans from other banks without the PNB's knowledge. The funds obtained through this method were the siphoned off and used for the personal gains. So, what are the impacts on PNB? The PNB suffers a massive financial losses and its reputation was severely tarnished. The scheme revealed systematic flaws in the banking sector's risk assessment and the control mechanism. It has also raised the concern about the complexity of the bank's official in the fraudulent activities. Nirav Modi and his uncle Mehul Choksi fled the country to avoid arrest. Indian authorities have been working to extradite them from the countries where they have taken refuge. The second one, Vijay Mallya and the Kingfisher Airlines debacle. Vijay Mallya, the flamboyant businessman behind the Kingfisher Airlines, became the synonyms with the financial fraud in India. His airline's downfall and the subsequent loan default worth rupees 9,000 crores shook the nation. So Kingfisher Airline borrowed the substantial sums from the multiple banks but failed to repay these loans. Mallya is accused of diverting the funds away from their intended use and using them for the personal needs and other business endeavors. Loans that were not repaid but a tremendous financial strains on the institutions. After Mallya left in India 2016, more claims of financial impropriety and the money misuse surfaced, adding to the scandal. Vijay Mallya was a subject of extradition proceeding in the UK where he requested shelter in UK. The case served as a reminder that lending practices need to improve in the terms of due diligence and the risk assessment. The Rotomake Pain's fraud. The Rotomake Pain fraud cases revolves around the Vikram Kothari and his family, who allegedly embezzled rupees 3,695 crore he borrowed from the various banks for their pen manufacturing business. So the Kothari family secured loans for their pen manufacturing business but allegedly diverted the funds for their purposes. Instead of using the money to enhance their business, they reportedly siphoned off and the personal enrichment. The banks that lent money for the Rotomac pains faced significant financial losses. The case revealed that the extent to which borrowers could misuse the borrowed funds. Vikram Kothari was arrested and faced the legal action after that. The fourth one is Punjab and Maharashtra Cooperative Bank (PMC Bank) scandal. The PMC Bank scandal, which came into light in the 2019, exposed a web of financial mismanagement and the cancelling the non-performing assets. These incidents had severe repercussions. The PMC Bank's management allegedly hid the non-performing loan extended to the Housing Development and the Infrastructure Limited, which is called HDIL Group. Loans were granted without the adequate collateral or the proper diligence. Thousands of depositors were unable to access their funds for an extended period, causing the severe hardship. The scandal raised the questions about the oversight and the governance of the cooperative banks. The RBI imposed strict restrictions on the PMC operations and legal proceedings are ongoing. Satyam Computer Services fraud. The The Satyam Computer Services fraud uncovered in the 2009 was one of India's most shocking corporate scandals. The founder Ramalinga Raju admitted to inflating the profits and the fabricating the assets. Here is the story. Raju and his associates manipulated the financial statement to show the inflated profits and non-existent assets. The fraudulent activities were an attempt to boost the company's stock prices and attract the investors' impact. Shareholders and employees suffered heavy losses when the truth came to light. It raised a concern about the corporate governance and the role of the auditors in the detecting the such fraud. Ramalinga Raju and others involved in the fraud faced the legal actions and the company was eventually acquired by the Tech Mahindra. Bank of Baroda Forex scam. The Bank of Baroda Forex scam was a case involving unauthorized remittances amounting rupees 6,000 crore from the bank's Ashok Vihar branch in the Delhi to overseas accounts. This scandal highlighted the need for the better internal controls and the regulatory oversight. The officials at the Ashok Vihar branch of the Bank of Baroda allegedly facilitated unauthorized forex transactions. Funds were transferred to the accounts of the Hong Kong and Dubai without the proper documentations or the underlying the trade transaction. Concerns were raised by the schemes over the financial industry's susceptibility to move to money laundering. One of the biggest public sector banks in India suffered the reputational harms as a result. The bank strengthened its internal control and the commenced investigations after this. The Sarda Chit Fund Scam, the seventh scam. The Sarda Chit Fund Scam featured a Ponzi scheme perpetrated by the Sarda Group and notably affected the states of West Bengal and Assam. This is what transpired. The Sarda Group lured investors by promising the high returns through the chit funds and the real estate investment. A traditional Ponzi scheme was established when the money raised from the new investor was utilized to pay returns to their earlier investors. What are the impact? The numerous demonstrations and the political turmoil resulted from the swindle, which caused thousands of investors to lose their funds. It exposed the regulatory gaps in the oversight of the chit funds and the collective investment schemes. So several arrests were made, and the case led to the increased scrutiny and the regulation of the chit funds and the similar investment schemes. The Pulse Agrotech Corporation Limited scam, this scam number 8, which is also called a PSL scam. The PSL scams involved a land pooling and the real estate development scheme by the Pulse Agrotech Corporation Limited. The company collected amount 49,100 crore from the investor but failed to provide the promised land parcel. PSL collected money from the investor by promising them agricultural land. But instead of buying the land as a promise, the business instead ran a huge Ponzi scheme. Millions of investors, particularly in the rural areas, were impacted and they lost their hard-earned money. The case exposed regulatory gaps in the oversight of the collective investment schemes. Aftermath, the SEBI declared the PSL's activity a Ponzi scheme and initiated a effort to refund the investors' money. The ninth one, the Winsome Diamonds and the Forever Precious Diamond scam. The company, the Vincent Diamonds, involved the loan default by this company leading to debt over 7,000 crore. The Vincent Diamonds borrowed the significant amount from the banks and the financial institutions for their diamond trading business. Due to the enterprise's loan default, the lender suffered enormous financial losses. Due to this default, banks and other financial institutions were faced with the sizable non-performing assets. The case highlighted the need for the stricter loan appraisals and the monitoring mechanism. Legal actions were initiated against these defaulted companies, and the case drew attention to the issue of NPS in the banking sector. ILNFS Financial Service Debacle, the 10th scam, the infrastructure leasing and the financial services crisis unfolded in 2018 and revealed a complex web of the financial mismanagement and default. The ILNFS and the subsidiary borrowed extensively to the fund infrastructure project but faced challenges in the repaying the debt. The crisis exposed the weak corporate governance, lack of transparency, and the risky lending practices. The ILNFS crisis triggered the panic in the financial market, leading to the liquidity challenges. It exposed the vulnerability of India's infrastructure financing sector. So, aftermath, the government initiated the takeover of Fire and FS and embarked on a massive restructuring effort to stabilize the situation. So, what are the role of the regulatory bodies? The following this fraud, regulatory organizations like the SEBI and the RBI have been forced to reflect and improve their supervising practices. The PMC Bank incident made it clear the need for the more stringent oversight and the governance among the cooperative banks, leading the RBI to review its framework for supervisions and enforcement. Similar to this, SEBI strengthened and its regulations of the collective investment schemes in the response to the Sarda chit fund fraud. Preventing the future frauds require multi-pronged approach involving the institutions, regulators, and the individuals alike. Here are the some key strategies to mitigate the risk of such incidents. So we have to enhance the due diligence. Financial institution must conduct thorough due diligence before extending the loans or providing the financial services. This includes the verifying the authenticity of the document and the collateral, as seen in the Rotomac pains fraud. Stricter controls, corporates, banks and the corporations must establish and enforce stricter internal controls to prevent the unauthorized transactions and the fraudulent activities, as exemplified by the Bank of Baroda fraud scam. Whistleblower protections, encouraging the whistleblowers and providing them with the protection is crucial. Whistleblowers played a significant role in exposing the certain fraud. Regulatory vigilance, regulations such as the RBI and the SEBI should continuously monitor the financial institutions and take prompt action against the violations, as demonstrated in the PSCL scam. Awareness and education, individuals must educate themselves about the financial products and the services and the exercise cautions where investing or the banking. Public awareness campaigns can play a pivotal role in this regard. Collaborative efforts, government agencies, financial institutions, and the law enforcement must collaborate to investigate and prosecute the financial crimes effectively. The Winsome Diamonds and the Forever Precious Diamonds scheme illustrate the importance of the such collaboration, transparency, and accountability. Corporations and the financial institution must uphold the high standards of transparency, accountability, and the ethical governance as exemplified in the Sarda chip fund scam.